This is Kathy with CallCathy.com, eXp Realty. Been licensed agent for 22 years, and over all of my career, I've actually worked with many lenders, and one of our favorite go-to lenders is Keith Brown. We met him on a transaction where a buyer needed financing, special financing that wasn't approved, and Keith was able to get the job done. So he's here today to share with us some news about the recent drop in rates. Keith, what's going on? Tell us what we can expect.
So I'm Keith Brown with Intercoastal Mortgage. We've been in business since 1987. I've worked with the company for almost 30 years. So what basically happened is yesterday, Wednesday, September the 18th, the Fed finalized their two-day meeting. And what got all the news was the Fed cut the short-term rates 0.5%. So what does that basically mean? The Fed directly controls short-term rates. These are things like the rates on your credit cards, rates on any home equity lines of credit, rates on investment accounts like savings, checking accounts, and money markets. So in a lot of cases, with the Fed cut of 0.5% yesterday, those type of instruments all went down 0.5% immediately. However, the Fed does not control long-term rates. Long-term rates are things like your auto loans and your mortgages, which is what we're mostly concerned with.
Yes.
Now, leading up to the Fed cut today, the market has been speculating for the past 90 days that the Fed was going to make a pretty big cut at this meeting. They were expecting a 0.5% cut in the rate, and the Fed did basically what was exactly expected. If we go back 90 days ago to the last Fed meeting in June, mortgage rates on average are running just over 7%. Before the Fed meeting yesterday, the rates had actually dropped almost a full percentage point, running in the low sixes, at 6 1/8 range. So the market had essentially priced in what the Fed was expected to do. And so since the Fed did what they were expected to do, we didn't really see much of a change in the mortgage rates. Now people ask, well, wait a minute, why didn't the rates go down 0.5%? The Fed did come out and hint that they might be doing further cuts as needed in the future. The Fed chairman, Powell, actually indicated that by this time next year, we could see up to another 1% decrease in the federal funds rate, which would be great for mortgage rates. However, when he was going over the reasons behind why they cut the rates recently and what they're planning to do in the future, he painted a rosier picture of the economy than what a lot of the market was expecting. The market was essentially expecting that the Fed was going to predict more doom and gloom. And while inflation has been coming down and we're around that 2.3, 2.4% mark, which is really good, at the same time, the economy has been slowing down. GDP's gone down a little bit. Unemployment has increased very slightly. New job creation has kind of stagnated. The new jobs being created right now are mostly in the service industry and not high-tech industry or manufacturing. So, the markets were expecting the Fed to be a little more cautious about the economy, and the Fed actually came out and said, you know what, while we do see some things on the horizon, it's not doom and gloom. Things are looking better. And so that means that we're probably not going to get another aggressive Fed cut for at least maybe until December. And so that wasn't quite what the markets wanted to hear. And as a result, mortgage rates actually increased very slightly yesterday in spite of the 0.5% Fed cut. Now on the flip side, the stock market, hearing that the Fed is not as concerned with the slowdown in the economy as they originally thought, the stock market took off today. The stock market shot up 1.7% for a single day trading. It hit new records across all the indices. So it was great news for the stock market, not necessarily the greatest of news for the bond market. Now, going forward, we do expect that over the next 6 months, we probably will see rates continue to improve because the Fed did indicate that with inflation now finally on this decreasing trend, we could see inflation continue to get towards that 2% target rate, which is what everybody wants. And at the same time, unemployment will probably gradually continue to grow very slightly, but the Fed will keep cutting the rates on a pretty moderate pace. And over time, that means rates are going to continue to improve. So there is good news on the horizon. We just didn't see this big, massive drop in the mortgage rates today because the market had already pretty much priced it in over the last 90 days, and the Fed did exactly what the market expected them to do.
So Keith, what do you expect to happen with purchasers? What does that mean to purchasers in today's market?
So it just means that rates are much better now than what they were a year ago, and they're only going to be continued to gradually improve over the coming months. Like one thing we've been seeing is that there's a tremendous amount of pent-up demand in this market. There's a lot of buyers out there. This is a high-income area. People have money. And as the rates continue to improve, that's going to get more attention. We're going to see more buyers coming out. And the more buyers that come out, the more demand there is for housing, more likely prices are going to start to increase again because there is no more new housing being created. One thing about the Washington area, we're recession-proof. This is, if you want to do business with the government, this is where you've got to be. At the same time, this area has we're second only to Silicon Valley in the number of IT companies that are out here. We actually have more data storage warehouses, think cloud storage, than anywhere in the nation, in Loudoun County. And then you have the entire defense contract industry that's out this way, again, because of the federal government. So there's no new housing, there's all these high-paying jobs. As the rates come down, more buyers mean higher prices. So if you are thinking of buying, now's the time to get in on it, because rates might come down, but prices are probably going to increase and more demand. We're still recommending now's probably a good time to buy. If the rates drop over 1% over the next year, you can always refinance. But if that house goes up $20,000 or $30,000, well, you're paying whatever the market value is for that house.
So what are you seeing with more loan pre-approvals and
Sure.
in your office lately?
So we're doing a pretty good pace on pre-approvals. Again, one thing nice about this market is we're mainly dealing with a well-qualified, well-educated, very sophisticated client base. Unfortunately, if you're a first-time buyer, it's tough. We don't have money for a down payment. It's tough. There are some first-time homebuyer programs out there, but the ones designed to help with down payment assistance have very limited incomes. For example, the Fannie Mae, Freddie Mac, Home Possible, Home Ready programs. These programs have a cap of $120,000 a year in income. Most dual income households in this area are making over $200,000. We have other programs that'll go up to $180,000 for first-time buyers, but they offer maybe some slight rate improvement. They don't actually help with down payment assistance. So, honestly, most of the people we're approving right now are people that, they've sold a house and now they're looking for their next home, or they're living in a townhouse or a condo and they want to upgrade to that larger house. Vast majority of our clients are coming from majority of our clients, extremely well qualified. High income, high net worth, large down payments. That's the market we're in right now.
Got it. And so what's interesting is I do a lot of listings. I list a lot of properties,
Yep.
and we meet buyers from our listings. So buyers that are perhaps selling and buying, like Keith says. But today, for instance, Keith, we had a buyer a first-time home buyer that got pre-approved. They were not approved to purchase 3 years ago. So they've been renting for the last 3 years. And Keith, you had the opportunity to talk to them 3 years ago. So they are first-time home buyers. What's exciting is we went out and we looked at 3 properties, and two out of the 3 properties were new listings, and the third one had been sitting on the market. And ironically, they actually like the one that's been sitting on the market. It needs a little work, but they feel like they can get into the market. And the rates have improved just a little bit from where they were just a year ago. So we're excited to proceed with the next steps of submitting an offer.
And even that client being a first-time buyer, they're a great example of, they're a first-time buyer, but again, they're high-income individuals. They're north of the income limits for all the programs. And because they've been renting, they've been saving all their money, they're able to do a large down payment. So even though they're first-time buyers, they're not the typical first-time buyer, limited income, limited down payment. That's kind of the first-time buyers I'm seeing is couples that are making good incomes. They want to buy a house and they've been saving prodigiously to get to that point. And that's kind of the buyers we're seeing in this market, right now.
Have you seen any buyers that have submitted an offer with FHA financing recently? I'm just curious.
I have to be honest. I have not done more than 2 FHA loans in the past 2 years. FHA loans are a great tool, but let's be honest. If you're going an FHA loan, that's a signal to the listing agents you have credit issues. Because if your credit's good, if you got a credit score of at least 740 or better, which majority of our clients have, conventional financing is cheaper, and there's cheaper down payment options for it. Now, that's different than our veterans that are buying a home, VA buyers. The veteran program, VA program is 0.5% consistently below conventional rates. And, we regularly do retired veterans, recently separated veterans that are making extreme amounts of money, putting large down payments. But, if you're getting a 0.5% lower rate by doing a VA loan, you're going to take that. So the VA loans are the best deal for veterans, but we just don't see a lot of FHA loans because we're not seeing that client base that has those credit challenges. So we just aren't doing a lot of those mortgages.
That's really helpful,
Yep.
Keith. And what tips and advice do you have for today's buyer in the market that we're in?
Right. So first, number one tip is get pre-approved. You got to start by getting information as to what you're qualified for, what your payments are going to be, what your cash out of pocket is. Because even if you're several months off, the average person I'm qualifying right now, Kathy, is really looking more 4 to 6 months, even a year out. I referred someone to you recently, for example, that got qualified now, but her lease isn't up for almost 8 months. But she needed to know, what am I looking at for payments? What do I need to target for savings? How's my credit? Is there anything I need to tweak on my credit?
Smart.
Because a slightly higher credit score can make a big difference in your rates and mortgage insurance if you're putting less than 20% down. So we got her pre-approved. Turns out things were better than expected. And she also has a target for what she's trying to save.
Perfect.
But the other thing that she was really surprised to learn is that she had in her mind, a lot of people have this thing in their mind, like especially the first-time buyers, have known that they have to hit 20% down. If you have great credit scores, and I'm talking 760 or above, the mortgage insurance on a conventional loan is discounted by as much as 75%. So, people always, when they do these online calculators, they see mortgage insurance costing hundreds of dollars. In her case, she could do, for example, instead of trying to kill herself to save 20% down, she could do a 10% down payment. And for her, on a $500,000 mortgage, the mortgage insurance cost was $68 a month.
That's it.
That was it. And she looked at that and said, you know what? I can buy a house right now. I'm going to keep saving. But the nice thing is, if something drops in her lap that she falls in love with, she can act on it now because she doesn't need to save that other $50,000 or $60,000. The client that you mentioned today that's looking to make an offer, it was revelatory to him because, again, he was thinking I had to do 20% down. He said, well, wait a minute, you can do 15% down, keep some money in the bank if you have to make repairs, because he's looking at a much higher price point. His mortgage insurance was $48 a month on a rather good sized mortgage. So again, the mortgage insurance isn't something to be scared of, and you won't know what your mortgage insurance rate until you get pre-approved because your credit score decides that. But it can allow someone who has limited savings to look at buying now versus struggling to save that 20%. Mortgage insurance is very affordable, down payments as little as 5% down with great credit scores.
Wow. And Keith, with buyers that are looking in today's market, and what do you say to a buyer that says, I think I'm going to wait until rates come down a little bit further?
So the only thing I remind them is, first I always show them that, even a 0.5% difference in rate isn't as big a difference as you think it's going to be on paper. It really isn't, depending upon your price point. What is a big difference is when you're at 6% versus 3 months ago, about 6 months ago, we were almost at 8%. That's a big difference. Mm-hmm. But once you start getting around that 6.5 and below mark, the difference in rates aren't a huge difference in the payments. And like I mentioned earlier, demand, pent up demand. The lower the rates get, the more buyers come out of the woodwork, the more buyers you're up against, the more likely you're competing. And if you're competing against an offer, now you're going to run, especially the more offers you compete against, you're going to get that one offer out that's coming in that makes no sense, way over list price, waiving appraisal, waiving financing, putting an ungodly amount of down payment. At least right now in the offers I'm seeing, there's some competition, but instead of being like 5 or 6 offers, it might be 1 or 2 offers. There might be some negotiating on the price. Not everybody's necessarily coming over list. The last couple contracts I've done this month haven't been able to keep their appraisal and financing contingencies, which has been very rare. So that's what I'm telling clients. This is a good market to buy. And if you wait for the rates to fall, you're probably going to pay more for the house, and you're going to see a lot more competition for those homes. At least right now, there's some equilibrium in the market, and it's getting more of an even market for sellers and buyers, more of a level playing field.
Great advice. So Keith, thank you so much for sharing all of your knowledge, and we always appreciate your time. We're looking forward to doing more business with you, and of course we're looking forward to more buyers coming out, and more sellers getting their homes on the market. Any sellers out there, it's a great time to actually put their house on the market as well. And with rates coming down, there's an opportunity for those sellers to also trade up to the next property that they've been waiting to do.
Absolutely. So thank you very much, Kathy.
You're welcome.